Welcome to Real Estate Capital and Growth USA. Today, we're uncovering the secrets behind the Real Estate Business Credit Score, a key factor for investors across the USA. From New York to California, understanding this score can provide clarity for every property professional looking to navigate the world of real estate funding strategies effectively. Before we dive deeper, let's explore why this seemingly mysterious score holds significance for so many investors. What is a Real Estate Business Credit Score? The Real Estate Business Credit Score is an indicator used by lenders and investors across the USA to gauge a company's financial reliability. Unlike personal credit, it focuses solely on business activity, including previous transactions, trade experiences, and payment history. While it may seem abstract, many successful investors like Jackson in Chicago view it as a strategic tool to understand their business footprint. Now, let's break down how this score functions in the real estate investment landscape. At its core, the Real Estate Business Credit Score is not about personal spending habits. Instead, it emphasizes patterns tied directly to business operations. For instance, if a company has consistent vendor payments or maintains transparent trade relationships, these behaviors contribute positively to the score. This makes it a powerful reflection of business accountability. Consider Jackson's case in Chicago. Over several years, he operated multiple rental units under his business entity. By maintaining detailed transaction records, his real estate business credit score became a valuable mirror of his business's reliability. Rather than a judgment of his personal financial status, it functioned as a neutral snapshot of his company's operational discipline. This example highlights how the score provides clarity, not conclusions. Now, let's look at the broader meaning behind this metric for investors nationwide. Ultimately, the Real Estate Business Credit Score acts as an informative benchmark. It reflects patterns of trustworthiness and consistency within the USA property market. For investors, whether in Chicago, Dallas, or Los Angeles, it becomes part of the bigger picture, understanding one's business presence, not receiving financial instructions. Clarity, awareness, and measurable business footprints are the real value here. With this understanding, we can now examine the main factors that usually influence this score. Key components of the score. Several elements contribute to the Real Estate Business Credit Score, a benchmark widely used across the USA real estate market. From timely payments to trade relationships, these components build a snapshot of business reliability that influences how an investor's company profile is viewed. In cities like Austin, Texas, or Miami, Florida, professionals closely monitor these elements as part of their operational identity. To understand this better, let's explore the fundamental building blocks that make up this score. The first component is timely payments. When businesses meet their obligations on time, it reflects consistency and strengthens their real estate business credit score. The second is credit utilization, how much of the available business credit is actively in use. High utilization may signal strain, while balanced use reflects steady operation. Third, the length of business activity plays a role. A company with 10 years of operation demonstrates a longer track record than a recently formed entity. Finally, trade relationships matter, as partnerships with vendors and service providers help shape a business's credibility in the marketplace. Take the example of Lily, an investor based in Austin. She owns several rental units and consistently monitors these components. By tracking payment patterns, credit use, and vendor reliability, Lily sees how her real estate business credit score functions as a mirror of her professional presence. It doesn't provide financial advice but serves as an informative marker of her business profile. Now, with this overview, let's see how these principles apply when mapped onto real scenarios over time. In conclusion, the Real Estate Business Credit Score is shaped by multiple components working together, payment history, credit utilization, operational length, and trade reliability. For investors across the USA, from Austin to Miami to Los Angeles, these factors create a measurable outline of their professional activity. The key takeaway is simple: this score highlights consistency and operational patterns, serving as a transparent reflection of business presence. With that clarity, we can now move toward practical examples of how investors engage with their scores in real time. Case study: Midwest investor. The real estate business credit score in the USA is more than just a number, it's a living reflection of a company's consistency and discipline. In Denver, Colorado, where the real estate market thrives with both residential and commercial properties, investors like Aaron use this score to shape their understanding of long-term stability. Unlike personal credit, this indicator tracks only business activity, providing clarity for those who want to evaluate their professional footprint. And Aaron's journey offers a concrete example of how monitoring patterns can create perspective for growth. Aaron, a Midwest investor operating in Denver, analyzed his real estate business credit score over a 5-year period. Instead of looking at short-term numbers, he focused on long-term patterns such as timely payments, trade history, and credit utilization. This approach revealed the evolution of his company's stability and helped him identify periods of stronger performance. For example, when Aaron observed that his trade experiences were consistently positive, he connected it with increased trust from suppliers. Without entering the financial or legal domain, this demonstrates how businesses can recognize signals of professional reliability. His study became less about immediate transactions and more about evaluating the big picture of business health, similar to how a medical chart gives a long-term overview of well-being. This analytical mindset positioned Aaron as a model for many real estate investors across the USA. Aaron's case study illustrates how the Real Estate Business Credit Score USA acts as a strategic monitoring tool. Rather than relying on instinct or isolated data, investors like him observe recurring patterns that highlight business resilience. This case from Denver reminds us that analysis over time is the key to understanding a company's identity. This broader perspective underlines why monitoring and analysis matter more than isolated numbers. Common misconceptions. Introduction. The Real Estate Business Credit Score USA is often misunderstood by many investors who believe it directly determines loan approval or financial favorability. In reality, this score reflects business reliability, trade activity, and professional presence in the real estate market. In Seattle, investor Mia discovered that by keeping accurate business records, her score evolved steadily, demonstrating the importance of perception over assumption. Let's now examine why misconceptions persist and how a clearer understanding reshapes interpretation. A frequent misconception is that a real estate business credit score functions like a personal credit score. However, the business version is rooted in measurable factors such as trade relationships, timely payments, and company history. Unlike personal metrics, it emphasizes how consistently an enterprise maintains its commercial identity within the real estate landscape. Take Mia's experience in Seattle. Over several years, she monitored her records without focusing on external approval. What emerged was a clear picture of her company's operational stability. Instead of being discouraged by myths, Mia embraced the score as a mirror of her professionalism. This highlights the analytical role of the score. By looking at it as an indicator of business behavior rather than a pass or fail label, investors across the USA gain a broader, evidence-based perspective. Such clarity enables the real estate industry to separate facts from assumptions. The lesson from these misconceptions is simple: the real estate business credit score is not a verdict, but a reflection. Investors who view it as a tool for monitoring business activity, like Mia in Seattle, discover insights that myths often obscure. By prioritizing accurate analysis, real estate professionals strengthen their long-term vision. This perspective prepares us to approach the score as an analytical guide rather than a barrier. Practical usage for investors. The Real Estate Business Credit Score in the USA acts not as financial advice, but as a reliable benchmark for business clarity and growth. For investors like Brandon in Miami, this score becomes a compass that highlights patterns of operational strength and long-term consistency. By comparing his company's trajectory year after year, Brandon discovered that tracking his business credit profile provides valuable insights into his overall presence in the real estate market. Now, let's analyze how observing these patterns contributes to a clearer professional footprint. The role of the Real Estate Business Credit Score lies in its ability to capture and reflect a company's evolution. While it does not guarantee loan approval or financial outcomes, it serves as a tool that sheds light on business reliability, payment records, and operational discipline. Brandon's example in Miami illustrates this point. Instead of viewing the score as a pass-or-fail system, he focused on monitoring it as a progress report. Over time, his company's steady performance revealed not just numbers but also a narrative of consistency. This perspective enabled him to recognize when his operations were aligned with sustainable practices. From an analytical standpoint, this usage enhances transparency. It allows investors to evaluate how their business activities are recorded in the larger system without venturing into legal or financial interpretation. The outcome is not advice but a clearer understanding of one's footprint in the real estate ecosystem of the USA. The practical takeaway is that the Real Estate Business Credit Score serves as a mirror, not a map. It reflects how investors like Brandon in Miami build credibility through consistent actions. When approached as a benchmark for transparency and operational discipline, it empowers real estate professionals to see beyond assumptions and focus on long-term clarity. This opens the path to connect score monitoring with broader investment perspectives. Integration with investment planning. The Real Estate Business Credit Score in the USA can play a subtle but significant role when integrated into investment planning. While it does not serve as financial or legal advice, it functions as a structured reference point for operational reviews and strategic alignment. Investors often use it to examine patterns, highlight areas of consistency, and maintain clarity in the fast-moving real estate environment. For instance, Olivia in Boston relies on her score as a way to organize internal records and track shifts across multiple property activities. Let's explore how this integration creates a broader lens for understanding business activity. In practice, the integration of the Real Estate Business Credit Score offers a framework for perspective rather than prediction. By treating it as an index of reliability, investors are able to evaluate whether their operations align with long-term organizational goals. Olivia's case in Boston illustrates this usage clearly. Managing several multifamily properties, she regularly reviews her company's score, not to make immediate financial choices, but to maintain a record of professional discipline. Her process involves comparing year-to-year data, reviewing trade interactions, and mapping activity patterns. This allows her to build a timeline of consistency and to see where her business is heading. The benefit is informational. It gives investors a non-biased benchmark that exists independently of personal credit, situating their activity firmly within the professional real estate domain in the USA. Ultimately, integration with investment planning does not mean replacing expertise or due diligence. Instead, the Real Estate Business Credit Score acts as a compass for internal reflection, guiding investors like Olivia in Boston to maintain structured records and observe trends. When viewed in this way, it supports long-term clarity without overstepping into advisory territory. Finally, let's summarize what we've learned and why it matters to investors nationwide. The Real Estate Business Credit Score for investors in USA remains a vital informational benchmark. By monitoring it closely, professionals strengthen clarity, transparency, and long-term perspective. From Aaron in New York to Olivia in Boston, real estate investors use this score to align strategies and recognize growth signals. Observing patterns builds an accurate picture of operational presence. This conclusion highlights its role in offering structured awareness across multiple markets in the United States. Ultimately, this tool isn't about predictions, it's about clarity, strategy alignment, and a deeper understanding of one's business footprint. If you're finding value in these insights, consider subscribing to Real Estate Capital and Growth USA so you don't miss our upcoming breakdowns on real estate strategies across the nation. Thank you for watching. See you in the next videos.